Hey everyone, I'm Adam Cohen and you're watching Adam Cohen Today. We will be discussing real estate, hard money lending, the art of the deal, and how to be a successful real estate entrepreneur. There are two types of people in life. There are hustlers and workers. The hustlers never work and the workers never hustle. I've been doing this for 25 years. I have seen and done it all. Watch my show and become a real estate rockstar. Thank you for watching. Hi everyone, you're watching Adam Cohen Today. I am your host, Adam Cohen. Today we're going to talk about the upside of hard money lending. Many people think that only people with bad credit qualify for a hard money loan. The truth is that many borrowers come to us for hard money simply because they have to close in a short time frame, they're looking for no prepayment penalty, or they can't get the loan from the bank the way they want to. The upside of a hard money lender is that, unlike an institutional fund, we can make on-site decisions based on the transaction, based on the merits. Hard money loans can generally be closed in 5 to 10 days, depending on the transaction. Whether you have good credit, bad credit, it doesn't make any difference. The hard money is asset-driven based on the collateral that's being presented. The difference between a hard money loan and a bridge loan generally are people who qualify for a bridge loan would also qualify for a bank loan, so the rates are a little better. People with bad credit usually will only get a hard money loan or end up going to pay the higher rate. The advantages are they can rebuild their credit, they can pay the loan off in 12 months without paying a large prepayment, and they'll get a loan that otherwise they wouldn't have gotten elsewhere. How do you identify a legitimate hard money lender? There are a lot of companies out there representing to be a direct lender when really they are not. The best thing that you can do is to really do your homework and due diligence. Look in Google and other search engines to see if they have any complaints for taking deposits and not closing loans. Ask them to provide references or evidence of transactions they've recently closed. Real lenders will generally provide you information on business that they've done and will not ask for large upfront fees. Sachs & Spencer Capital charges no upfront fees for residential properties, and we only cover appraisal costs on commercial loans. Any other company that's charging larger amounts of money than would seem reasonable probably is someone to be suspicious of. What's the difference between a bridge loan and a hard money loan? Essentially, they are significantly similar. However, they do have a couple of little differences. Bridge loans can be generally from 1 to 3 years, where a hard money loan is usually for 12 months. Borrowers who qualify for a bridge loan usually have better credit and more experience, and they're going to get a slightly lower rate. People who need a hard money loan generally only have bad credit, and they're going to end up paying slightly higher rates. We know when we do a bridge loan that most likely we're going to be doing the refinance if the property is not going to be sold. With a hard money loan, we know that if the loan goes into default, we're taking it back. So that explains the higher rate. Essentially, it's a lower leverage and it's a slightly higher risk. What kind of real estate collateral qualifies for a hard money loan? The answer to that question is just about anything that's real estate related. From residential properties, providing it's not a primary residence, to commercial, to office, to land, to development. Anything that essentially has a deed, is real estate, is in an urban environment, is going to qualify for a hard money loan. The types of properties that will not qualify for hard money would be a primary residence, or owner-occupied as we refer to it. Rural property is quite often hard to finance, or something, for example, that doesn't cash flow or there is no exit strategy. But just about anything else would qualify real estate related for hard money. Unrealistic versus realistic expectations about hard money. A lot of borrowers come with unrealistic expectations when it comes to borrowing money on real estate. One of the biggest expectations they have is the value. Most borrowers will overvalue their properties, whether they're buying it or refinancing it. It's very important to know the real value of your real estate. If you're trying to overvalue it by 10, 15, or 20%, an appraisal is going to be very disappointing, and there's no point paying for 5 appraisals to end up with the same result. Another important fact is timing. A lot of people come to hard money lenders expecting to close in a day. Realistically, we have to get value, we have to get title, we have to make sure their transaction is legal, we have to make sure the value stacks, and that there's an exit strategy. That can be done in 2 or 3 days, it can be done in 4 or 5 days. But no one's going to lend on a property where ownership is questionable, value doesn't make sense, and title can't be secured. The most important thing that you can have when you're doing a real estate loan of any kind is to know all the facts, to be prepared for it, and to do your due diligence. A lot of lenders, a lot of brokers will tell borrowers anything they want to hear in order to get a loan. Do your homework, call multiple companies, and use the most realistic and the most common information. If one company tells you they can do it in a day, and everyone else tells you they can do it in 5, then the answer is 5 days, not 1. Preparing to apply for hard money. Surprising as it may seem, so many brokers send my company hard money applications every single day. Without exception, all the applications are wrong. They come in with inconsistent information, they come in missing important files, they come in missing value, they come in missing documentation. Preparing for a hard money loan is like preparing for any other loan. There is a step-by-step process which is pretty consistent regardless of who you do business with. Virtually all lenders will require a commercial loan application known as a 1003. So you should have one ready. You can find this form online, download it, and complete it. A printed version of the 1003 is always better than a handwritten one. You should always have a valid copy of your ID, and you should always have verification of the whole transaction from start to finish. If it's a purchase, there should be an executed contract, there should be title and escrow. If it's a refinance, then you should have a local title company, have title updated, so we know all the mortgage payoffs and liens that need to be satisfied against the property. Other than that, do your due diligence on value. Know how much your property is worth and how much you can borrow, and if that works for you. How fast can a hard money loan close? That is the million-dollar question, or an ambiguous question as some might say. I've worked in the hard money industry for over 20 years. I've seen loans close from 24 hours to 30 days. Right? The difference being the complexness of the transaction, the overcoming hurdles, establishing value, clearing title. But the answer is, if you came to us, for example, with an appraisal that was acceptable, title that is clear, then the answer is 24 hours or even the same day. Having said that, typical turnaround time for a hard money loan is around 7 to 10 days, based on experience. Hard money lending for foreclosure properties, or distressed assets as we call them in the industry. It's not uncommon to be presented with a foreclosure property. Probably 3 out of 5 loans that we see are in foreclosure. The reasons for the foreclosure don't really matter. It could be a range of mismanagement, they took the funds for other projects, the bank called in the loan, tenants didn't pay the rent. The reasons are any one of 1,000, but foreclosure properties are probably one of the most common assets that we see for hard money lending. The upside of hard money for foreclosures is essentially when the banks say no, we say yes. We don't look at credit, we don't look at the history of the transaction, we look at the transaction today and the future of the transaction and where it could be, and we make a lending decision based on that. Yes, rates are higher, right? Leverage is lower, but for us, foreclosure properties make a great bread and butter asset, providing the borrower has a good plan and a good exit strategy. Paying off a hard money loan. Surprisingly enough, more hard money loans are paid off as agreed than foreclosed upon. Generally, they are paid off through sale of the property or refinance. When selling a property, make sure the sale price is sufficient to meet all your obligations, to pay off the loans, the liens, closing costs, and that there's enough money at the end of the day to put in your pocket. Quite commonly, borrowers come back to us at the end of their loan term for a refinance. Sachs & Spencer Capital offers multiple loan programs for transitional borrowers who are still building their credit or don't have all the financial documentations that a bank would otherwise expect. Transitional loans generally require no tax returns, no income verification, and essentially will pay off the hard money loan at a much lower rate on a 30-year loan term. Is all hard money lending equal, and where do hard money lenders get their source of funds? To be honest, not all hard money lending is equal. Different lenders have different appetites for different property types in different states, in different cities. Some like rural properties, some like urban properties, some like residential, some like commercial. Some will do smaller loans, some will do larger loans. So when looking for a hard money lender, you have to identify what is their appetite for lending. With respect to sources of capital, most private lenders have institutional lines of credit and private investor funds. When my company writes a loan, the combination of the funds that go into the loan will always be unknown to the borrower. We wire money into escrow, the loan closes, and the loan is closed. Behind the scenes, it's a combination of all of the above. We have private investors that will be part on the note, our own funds, and some institutional lines. But that's not a rule of thumb, and each transaction is unique. Can I get a hard money loan on a primary residence? The answer to that question, unfortunately, is always no. Private lending and consumer lending are significantly different, and most hard money lenders are not licensed to lend on a primary residence. So if you live in a property and you're pursuing a hard money, unfortunately, you'll have to explore other options. What are your options in paying off a hard money loan that's gone bad? It's not uncommon that a hard money loan will go into foreclosure during its term, meaning that it's not paid as agreed and the borrower is not making the loan payments. Most hard money lenders are a little bit more aggressive than the banks when pursuing foreclosure. You have to pay the regular interest, the default interest, which all adds up very quickly, when typically default interest is 25% plus the regular interest, which is probably 12%. So you could be as high as 37% in combined interest with the default, which accrues very quickly on a month-to-month basis. Your best option in getting out of a hard money loan that's in foreclosure is to sell the property if you can. Some people file bankruptcy, but ultimately that only buys a few months because most bankruptcy courts will dismiss the action as being evasive. On some occasions, when you're in foreclosure on a hard money loan, you can negotiate a forbearance agreement where you can pay the loan current or make interest payments until the property is sold. But that requires an ongoing exit plan that's agreeable to all parties.